Supermicro computer stock is down 52% in the last 3 months, and since the peak here at the start of the year, it's down closer to 60 plus percent or so. Year to date, you can still see it's up 53%, but yeah, it has completely given back all the, I would say, the AI pump we've had here at the start of this year. Now, the company still has a market cap of $25.6 billion. One share will cost you $436. Forward PE sits at 13 times. Now, of course, this is not high PE, but we also know that margins-wise, well, it's coming down. It's not that great. Now, growth-wise, as you can see here from the analyst estimates, fiscal year 2025 sales growth of 88%, EPS growth of 51%. Then going to fiscal year 26, sales growth of 12%, EPS growth of 30%, and then fiscal year 2027, reacceleration of sales growth of around 19%, and EPS still growing 25%. So they are growing quite quickly. Now, of course, whether you believe those numbers or not is up to you. Why am I saying this? Because one, we had a delayed 10K, and two, we had that Hindenburg Research short report, which I've covered already on this channel. You can find it in the top right corner. Now, currently from a valuations perspective, if you look at forward PE, EV to EBITDA, price to sales, price to free cash flow, and price earnings to growth, forward PE is around the 5-year mean, but of course the company right now is growing faster than before. Same for EV to EBITDA, price to sales is under 1, then price to free cash flow, well, free cash flow actually in the last couple of quarters was not positive, so you're not getting the updated metric here. Then price earnings to growth, 0.29. So yeah, currently I do feel that it is quite cheap, but of course, there is still that overhang. If we look at the current analyst price target, which by the way has come down by quite a lot since August, August 1st actually, the average analyst price target was at $1,033. Now it sits at $783, which represents close to 80% upside from the price we're at today. So yeah, do with that information what you want. Anyways, before continuing, if you enjoy this type of videos, leave it a thumbs up, subscribe if not, we really appreciate that. And by the way, thank you very much for whoever used my affiliate link to get a Koifin account. I really appreciate it. It helps yourself out and it helps me out as well. If you're interested, of course, do check all the links down in the description or in the pinned comment below. You can also go to fool.com/couchinvestor to get the top 10 best stocks to buy now. So let's continue. This is basically a major overview of why I think the stock is down 65% since the highs. If that's all you need, then you can definitely leave after this. So gross margins are down, supply chain issues, Hindenburg Research short report, delayed 10K, and well, increased competition, I would say, from Dell and HP, but mostly Dell. Then, not Dell, then we can see that over the last couple of years, of course, revenue has exploded, right? In the last 6 years or so, revenue has grown by 388%. Gross profit margin peaked, would seem that it peaked at around 18.2%, and now we're all the way back down to around 14%. So that's definitely something that is dragging the stock down. Net income did increase 3,544% since Q1 of 2018, but of course has increased quite a lot more recently. If we look at the results from Q4 for their fiscal 2024, revenue increased 143% year over year and 38% quarter over quarter. But the problem, of course, is gross margin. Gross margin is down 580 basis points year over year and 430 basis points quarter over quarter. Earnings per share is down 40 cents quarter over quarter, but up $2.74 year over year. Cash flow from operations, well, it's not really cash flow from operations since it's negative $635 million. Now, with regards to SMCI, more specifically NVIDIA, or should I say Blackwell, so there are a couple of things we have to take into consideration here. Supermicro does not expect any Blackwell volume for Q3. For Q4, by the way, it's the calendar Q4, since we've just seen that it was Q4 their fiscal year. They expect only a small volume of engineering samples, with the real volume expected to be in March of next year. The company's full-year revenue guidance of $26 to $30 billion is relatively conservative, as they are not expecting significant Blackwell revenue until the March quarter. Supermicro prepared the market for a softening of margins in the previous guidance. However, the acceleration in liquid cool rack market led to higher supply chain costs, impacting margins more than expected, especially in the June quarter, which is why we've seen those results. Now, the launch of NVIDIA's Blackwell platform could open new market opportunities, especially in AI and high-performance computing. Significant revenue growth is expected in the March quarter next year as Blackwell volume ramps up, and Supermicro focus on liquid cooling solutions position is well to capitalize on the increasing demand for efficient cooling in high-performance computing environments. A little bit more on that front, they have shipped approximately 2,000 DLC liquid-cooled AI racks to customers, which they believe is more than 75% of the entire DLC liquid-cooled AI server market this calendar year. Of course, we know we've been talking about liquid cooling in the past. It's way more efficient than air cooling. Then, when talking about the delayed annual report, we indicated that based on the work done so far, this is the CEO saying, we don't anticipate any material changes in our fourth quarter or fiscal year 2024 financial results. This is good news. So, okay. I mean, it is good news because imagine if we'd said, oh, actually, there are some huge changes there. I think the stock would be down even more. He then touched us on the recent short seller report. So separately, you may have also heard about a recent report from a short seller hedge fund that contains false or inaccurate statements about our company, including misleading presentations of information that we have previously shared publicly. We will address these statements in due course. I mean, you've had your time, right? If I was a CEO, I would have been on TV the next day. So yeah, there is that. Then we've got a Needham bullish note, I would say. They have a buy rating on the stock and a $600 price target. Supermicro is likely to remain a significant beneficiary of the AI server trend, due in part to its first mover advantage in building GPU-based compute systems and liquid cool rack level solutions. As such, he expects SMCI to grow revenue on a compound annual basis in excess of 55% from fiscal 2021 to fiscal 2026. High growth. Now, more recently, there was a conference and we've got a little bit more information overall. So this is basically the summary. So Supermicro's success is attributed to its efficient, reliable systems, fast-to-market approach, and building block solutions. The company is a leader in liquid cooling technology, which is crucial for high-power AI and HPC workloads. Supermicro's vertical integration allows for rapid product development and customization. Strong partnerships with AMD, Intel, NVIDIA, and Broadcom ensure access to the latest technologies. The company expects continued growth demand for AI servers driven by cloud service providers and emerging AI applications. Supermicro is investing in production capacity expansion to meet growing demand. The company serves a diverse customer base, including hyperscalers, cloud service providers, enterprises, and OEMs. Last thing here, Supermicro aims to provide end-to-end solutions, focus on customer experience, and continue to differentiate its products. Of course, right now it's all about taking market share, which is why, well, we've seen, in my opinion, also margins come down more heavily than before. And so right now, this is basically it. From the peak here back in early March, all the way down to the what seems to be a bottom here at the start of September, stock went down 65.5%. Now, we are trying to make our way back up over the 20-day moving average, which sits at $482. The 50-day one sits at $587, and the 200-day one sits at $638. RSI is, I would say, low, but far from being oversold. Actually, I mean, since that huge crash, I would say, stock was not oversold. Why is that? Because the stock was heavily overbought. And so all in all, do I think that Supermicro is a good company to own? I think once the, let's say, smoke clears, I think this stock could go up quite fast. The problem here is, when will it clear, right? Again, we've discussed the short report. We've talked about what the analysts were saying as well. Yeah, okay, they did raise some good points, but most of the points were already addressed. Most of the points failed to actually come in with the knockout punch. So yeah, plus of course short sellers, when they have a position, so they benefit from that. They benefit from the fact that, well, when they will release that report, they benefit financially. So yeah, but yeah, the 10K delay, I mean, where is it? Still needs to be addressed. The CEO still needs to address all the points made by the short seller as well. Why is it taking so long, right? So yeah, I would say wait. What's the point of taking the risk, right? Even though I think risk reward wise it does make more sense today than before, I think there is time. Just wait it out. Even if let's say the stock goes up by 10-15% or so, at least you'll know, okay, the risk is gone because now we've got the answers. So that's what I think people should be doing if you're interested in super micro. That's about it from me. Of course, do share your thoughts down in the comment section below. Like, subscribe, do all of that, and I'll see you all in the next one. Bye bye.